If you want to trade in financial markets, it's important to put a strategy in place. So here are our top 5 tips on how you could improve your trading skills. First, you might want to decide what kind of markets you want to trade. Whether that's foreign exchange markets, indices, commodities, well-known individual stocks, or a combination of all of them. Then decide how long to hold your positions. Are you a day trader, a swing trader holding for a few days, or a position trader holding for weeks, months, and perhaps even longer? This could help your approach to market analysis. For example, if you're looking for the next big swing in the market over the next few weeks, perhaps even months, you probably don't want to spend too much time looking at a 5-minute chart of what's been going on today. And of course, conversely, if you're a day trader, your time could probably be better spent looking at the shorter-term charts rather than the longer-term big picture. Managing risk is a key component of trading, so at the outset, identify how much you are willing to lose and don't deviate from it. Here at Capital.com, we recommend that you should first trade on our demo account. Learn how to use the platform by trading fictional sums before you start trading with your own real money. Most people have a day job and have to fit their trading around that. For instance, if you're in Europe, that means trading in the evenings when the US markets are open. Of course, with any trading plan, it's important to think about a profit target and determine a stop loss in advance. We've produced a video on how to set a stop loss, which you can link to in the description below. Remember, you should never trade with more money than you can afford to lose. Markets trend over all sorts of time frames, up, down and sideways. So there are always opportunities to trade wisely to try to profit regardless of the market's direction. For an example of an extreme trend, you only have to look at a commodity we're all familiar with, oil. Since April 2020, oil prices have been on a wild ride.
Oil prices fell, ultimately turning negative for the first time in our history.
Plummeting to almost unthinkable negative levels, forcing producers to pay firms and investors to take it off their hands and store it. However, since then, oil prices have surged, moving higher than pre-pandemic levels.
Day in and day out, the exploration crews, nomads of the industry, travel the country in search of other potential oil deposits.
Everybody knows how to make money when asset prices rise, but as oil shows, good trades can even be made with a falling market price. This is known as short selling, looking to profit from a fall in the market. When short selling, to open the trade, you sell first and look to buy back at some point in the future. If you end up buying back lower, then clearly your short makes a profit. Of course, if the market rallies and you end up buying back higher than where you sold, you make a loss. For example, if you sold short oil at $40 a barrel and then bought back at $30, you would make a profit on the trade. Of course, if you bought back at, say, $50 a barrel after selling short at $40, then you would make a loss. Most people have a problem following trends and try to pick peaks and troughs, believing they can outsmart and outplay the market. But trends can persist much longer than we expect. Take 2 of the top tech stocks today. Over the course of the past 5 years, Apple's stock price has increased by more than 500%. But even that pales in comparison to Tesla. Lots of people have tried to call the top of the market for these businesses and have lost out. However, all trends do come to an end eventually. A good example of this is Peloton. A top performing stock at the start of the pandemic, its stock price fell dramatically throughout 2021. Managing risk is key to any trading strategy. Research shows that most people's trading losses are much bigger than their trading profits. So, keeping losses to a manageable amount, whatever that might be for your own risk profile, would be considered to be an important part of the overall trading strategy. You should create a stop-loss system in order to set a threshold at which you will admit you got it wrong. Let's look at gold. In November 2021, you may have thought that gold's price was going to move much higher and so decided to buy in at 1,860. However, by placing a stop loss at, let's say, 1,840, you would be able to limit your losses. You might have been disappointed that it didn't make a profit, but the price fell as low as $1,770 in December. By setting a stop loss, you would have managed your risk. Experienced traders understand the importance of managing risk. Whenever they open a trade, they know when to exit for a manageable loss. Our next tip is to keep calm and trade on. This is because of FOMO, the fear of missing out, the enemy of many a trader. Traders often see a market move and think if they don't jump in now, then they're going to miss the potential opportunity. More experienced traders know that if a potential opportunity does not fit their risk profile, then they will pass and wait for the next trade.
David versus Goliath brawl on Wall Street.
GameStop.
Take the GameStop hype. Many observers of this could have looked enviously at those who made money from the surge. However, those who bought the stock during the hype period would have incurred big losses shortly afterwards. Markets are always moving. As traders, our job is to pick the best potential opportunities and not just get panicked into a trade because we're afraid of missing out. Trading is difficult. All traders will lose money on at least some of their positions. Don't personalize your losses. You need to be detached. Whatever you do, don't fall in love with the market or the stock. Because there's real money at risk, movements in markets can play with our emotions, and trading based on emotion is seldom the key to success. Your emotions can interfere with the way you trade in several ways. For example, you can be too bold and just plunge into a trade recklessly. On the other hand, your fear of losses can mean that you exit a winning trade far too early. If trading was easy, then everybody would be making money from it, but we know that's just not the case. If you put in place a sensible trading plan and understand the importance of managing risk, you'll be approaching the markets from a more informed point